Should I begin?
Yeah, today we have a great Professor Alvin will start Payment 101, Payment Industry 101 class. So we are all welcome Professor Alvin. Uh, Alvin, first, can you introduce yourself and then we can go ahead to listen to your lecture.
Okay. Hello, everyone. I'm a retired professor of English, and I've been asked by Dr. Sarah Sun Liu to share with you the Payment Industry 101 course. We're going to, uh, I'm going to read it through so you understand, and um, go through the entire course bit by bit.
Yeah, great. Thank you so much for joining. I'm very appreciation. And I have excellent Professor Alvin working for our MIT, Meridian Institution of Technology, as well as the Meridian Business Legal Investment Foundation, also Meridian Sales Academy. Thank you, welcome, and thank you for all. And let's go ahead to start. Let's go ahead to start.
Okay. Payment Industry 101. What is payment processing? Payment processing is the series of actions that occur when digital payment transactions are initiated by a business. It includes everything from processing a card and opening secure gateways to communicating with issuing banks and consumer accounts. The benefits of payment processing are that it allows transactions to be quick and effective. The information is sent securely from merchant terminals to consumer banks and back in a matter of seconds. These systems manage all of the communication between issuing banks, credit card companies, and financial institutions. And they do it all without requiring the cashier to understand or get involved in the process. There are different types of payments. They include debit and credit cards, digital wallets, bank transfers, and electronic checks. The payments are processed when a customer presents their card to a retailer, either in person or online. The card data, including the cardholder's name and account number, is passed through a payment gateway, which then sends the details to the merchant's bank. The consumer's bank confirms whether there are sufficient funds available for the purchase to take place. The transaction is either approved or declined. There are 36% of merchants accept credit card and debit cards for payment, and 75% of transactions for the average U.S. consumer involve a digital payment. The payments are processed by the issuing bank, letting the retailer know by communicating with the payment processor. The issuing bank lets the retailer know by communicating with the payment processor. I think we did that. Payment gateways. Payment gateways are a service that links together all of the entities involved with the transaction and helps disparate systems communicate with one another. They establish secure connections to transmit data between parties via encryption. They send card data to the payment processor for the transfer of funds. They inform the merchant and consumer when the payment is complete. Most point of sale, POS, systems and card terminals have payment gateways. What are payment processors? Payment processors are the entities that handle the actual logistics of those requests. They authenticate the transmitted information to confirm that it is valid with all of the banks involved. Subscription subscription charges monthly or yearly fees, but could also include per transaction charges for services. Interchange Plus. These charge interchange fees per transaction on top of a set additional fee for processing. A typical charge would be 2% of the total transaction plus an additional fee of 0.5%. Flat rate. These charge static one-time fees per transaction, but their costs tend to be higher than other options. Merchant accounts and processed payments are different from bank accounts and only used for credit or debit card processing. They act as holding areas for funds during the settlement of pending transactions. They come into play after a card payment is processed and funds are approved. From there, the money is transferred from the issuing bank to the merchant account for holding and processing. Many systems come equipped with encrypted gateways to prevent data from being interpreted if it is inadvertently accessed. They look for a point-of-sale system that works with EMV chip cards. EMV stands for EuroPay, MasterCard, and Visa, and refers to the microchips that are embedded in the front side of newer credit and debit cards. Some of the best practices for payment processing. Businesses can also familiarize themselves with the payment card industry data security standard, the PCI DSS. The Federal Reserve System. The Federal Reserve System is the central bank and monetary authority of the United States. It was created on December 23, 1973, with the enactment of the Federal Reserve Act. The role of the Federal Reserve System is that it establishes and enforces the rules regarding the acceptance and use of payment networks by its members. It does not directly participate in credit card processing, but sets regulations and rules for financial transactions. Who approves or declines the credit card authorization once the acquirer passes to the card network? The issuer, typically a bank or credit card company, is responsible for approving or declining credit card transactions based on the cardholder's account status and credit worthiness. Who passes the authorization request to the card network once the merchant swipes the card through their terminal? The acquirer, often a bank or payment processor, forwards the transaction authorization request from the merchant to the appropriate card network. What is the definition of an independent sales organization, an ISO? They are third-party organizations or individuals that have relationships with the member banks and focus on the acquisition and management of merchants' accounts. What is the definition of an independent sales organization, an ISO? I just read that. ISOs work independently to sell and manage merchant accounts on behalf of acquiring banks, facilitating credit card transactions for businesses. Who sends the authorization code to the merchant once it's communicated to the credit card network? The acquirer receives the authorization code from the card network and relays it back to the merchant, completing the authorization process for the transaction. What was the first credit card made of? The first credit cards were made of paper and were introduced in the 1920s by companies like Western Union to provide credit for their services. What role do processors play in the payments industry? They establish partnerships with acquiring banks to provide payment processing services to merchants. Processors handle the technical aspects of transaction processing, partnering with acquiring banks to ensure smooth and secure transactions between merchants and card networks. Do payment aggregators, also referred to as PayFac TMs, focus on manufacturing POS hardware? No. Payment aggregators, or PayFacs, focus on providing payment processing services to merchants, not on manufacturing POS hardware. What was the name of the first credit card? The Diners Club card, introduced in 1950, was the first widely accepted credit card, initially used for travel and entertainment expenses. Some key events in bank card history and industry players. Consumers. Consumers are individuals who use various payment methods to purchase goods and services from merchants. These methods include checks, credit or debit cards issued by banks, prepaid cards, and cash. Consumers drive the demand for payment services and are the end users of the financial products offered by issuing banks and other payment providers. Merchants sell products and services to consumers and accept multiple payment types in exchange. Their transaction environments include card present, brick and mortar stores, card not present, e-commerce websites, electronic mail, and phone transactions, and unattended settings such as kiosks and self-service dispensaries. Issuing bank or user. Issuing banks provide financial services such as savings accounts, loans, and credit card issuance. They promote their payment cards, charge fees, interchange, and interest on card balances, authorize or decline purchases, and bill cardholders and collect funds. The issuing bank issuer types of cards issued include credit cards, which allow purchases on credit to be paid later with interest, debit cards, which provide electronic access to bank accounts with immediate fund extraction, and prepaid cards, which hold the value on the card itself and can be reloadable. Payment networks. Organizations like Visa, MasterCard, American Express, PayPal, Nacha, Star, and Genie. They establish and enforce network rules, partner with issuing and acquiring banks for transaction processing, and collect interchange and assessment fees. The payment network's market share in the US is as follows: Visa and MasterCard, 83%, American Express, 13%, and Discover, 4%. Acquiring banks. Acquiring banks play a critical role in the transaction process by working directly with merchants. They are responsible for providing merchants with the ability to accept credit card and debit card payments, managing merchant accounts, processing transactions received from merchants, and ensuring the funds are transferred from the issuing bank to the merchant's account. Merchant services. Merchant services, acquiring banks offer various services to merchants, excuse me, including payment terminals, payment gateways for online transactions, and fraud prevention tools. Transaction processing. They handle the authorization, capture, and settlement of transactions. Risk management. Acquirers assume some of the risks associated with processing payments, such as chargebacks and fraud. Processor aggregators. Transaction routing. They route transactions from the merchant to the acquiring bank and then to the issuing bank. Authorization and settlement. Processors manage the authorization of transactions and ensure that settlements are completed accurately and on time. Data security. They implement security measures to protect transaction data and comply with industry standards such as PCI DSS, which stands for Payment Card Industry Data Security Standard. Examples of processor aggregators. Processors. Companies like First Data, FistServe, and WorldPay are well-known processors that provide these services to merchants and acquiring banks. Aggregators. PayPal and Stripe are examples of aggregators that allow merchants to accept payments without needing their own merchant account. The Federal Reserve. The Federal Reserve batch settlement, The Federal Reserve facilitates the settlement of batch transactions, ensuring that funds are accurately transferred from issuing banks to acquiring banks. Regulation and oversight. It sets monetary policy, regulates banks, and ensures the stability and security of the financial system. Clearing and settlement services. Through its automated clearinghouse, the ACH, and Fedwire services, the Federal Reserve provides infrastructure for the electronic transfer of funds. Credit card authorization workflow. The workflow includes the cardholder initiating the transaction. The cardholder uses their card at the merchant's POS, point of sale, terminal, or enters card details online. 2, the merchant sends a request. The POS system or payment gateway sends the authorization request to the acquirer. And 3, acquirer processes request. The acquirer forwards the request to the appropriate card network, for example, Visa or MasterCard. 4, card network routes request. The card network routes the request to the issuing bank. And 5, issuer approves or declines. The issuing bank verifies the cardholder's account and available credit or funds, and the issuer sends an approval or decline message back through the network. 6, acquirer informs merchant. The acquirer receives the response and informs the merchant. 7, the merchant completes the transaction. If approved, the merchant completes the sale and provides goods or services to the cardholder. Fraud prevention measures include card verification value, the CVV. The CVV is used during the authorization process to verify that the card is physically present with the card holder. Address Verification Service, AVS. AVS checks the billing address provided by the cardholder against the address on file with the issuing bank. And real-time fraud detection. Many processors and issuers use real-time fraud detection systems to identify and block suspicious transactions. Handling declined transactions. Decline codes. The issuers provide specific decline codes indicating the reason for a declined transaction, such as insufficient funds, incorrect card details, or suspected fraud. Customer communication. Merchants and PayFacs often have procedures in place to inform customers of declined transactions and suggest corrective actions, such as using an alternative payment method. Interchange fees. The definition. Interchange fees are charged by the issuing bank to the acquiring bank for each transaction. These fees compensate the issuer for handling transaction risks and providing card services. The components. Interchange fees typically include a percentage of the transaction amount plus a fixed fee per transaction. Settlement timing. End of day settlement. Many merchants settle transactions at the end of each business day, ensuring timely transfer of funds. Real-time settlement. Some payment processors offer real-time or near real-time settlement options for faster fund transfers. Dispute resolution. Chargebacks. Customers can dispute transactions through a chargeback process if they believe the transaction is unauthorized or incorrect. Merchant response. Merchants must respond to chargeback requests by providing evidence to support the legitimacy of the transaction. Credit card settlement workflow. 1. Batching transactions. Merchants batch authorized transactions periodically and send them to the acquirer for settlement. 2. Acquirer submits batch. The acquirer submits the batch to the card networks for clearing. 3. Card network clears transactions. The card network calculates fees and forwards transaction details to issuing banks. 4. Issuer debits cardholder account. The issuer debits the cardholder's account for the transaction amount. 5. Issuer transfer funds. The issuer transfers funds to the card network minus interchange fees. 6. Card network settles with acquirer. The card network settles the net amount with the acquirer. 7. Acquirer credits merchant accounts. The acquirer credits the merchant's account minus fees. Payment facilitators, also known as PayFac. Payment facilitators, often referred to as PayFacs, simplify the process for merchants to accept payments by providing integrated payment solutions. Some of the functions. Merchant account provisioning. PayFacs streamline the setup process for sub-merchants by aggregating them under a single master merchant account. This eliminates the need for individual merchant accounts for each sub-merchant. Bundled solutions. They offer comprehensive solutions that include payment processing, customer service, accounting, online shopping carts, and inventory management tailored to the needs of their sub-merchants. Compliance management. PayFacs handle the complex PCI compliance requirements, reducing the regulatory burden on sub-merchants and ensuring secure transactions. Value-added services. They often provide additional services such as fraud detection, reporting tools, and analytics to help sub-merchants manage their businesses more effectively. Examples are PayPal, Stripe, and Square. Sub-merchants. Transaction processing. Sub-merchants rely on PayFacs to handle their payment processing needs, including authorization, capture, and settlement of transactions. Business operations. They benefit from the bundled solutions offered by PayFacs, which can include inventory management, accounting services, and customer support. Compliance. Sub-merchants benefit from the reduced PCI compliance burden as PayFacs manage security and compliance requirements. Examples of sub-merchants include small e-commerce stores, local retail shops, and independent service providers. Regulatory and compliance considerations. PCI DSS compliance. Standards. Payment Industry Data Security Standard, PCI DSS, outlines security measures that businesses must implement to protect cardholder data. Compliance levels. Different levels of PCI compliance apply based on the volume of transactions a merchant processes annually. Federal and state regulations. Federal laws. Regulations such as the Dodd-Frank Act and the Electronic Fund Transfer Act, the EFTA, govern various aspects of payment processing and consumer protection. State laws. Individual states may have additional regulations impacting payment processing, such as data breach notification requirements. Global compliance, GDPR. For businesses operating in or serving customers in the European Union, compliance with the General Data Protection Regulation, GDPR, is essential for protecting personal data. Cross-border transactions. International transactions may be subject to additional regulatory requirements and currency exchange considerations.